I'm Neil Mather, a junior at Hunter College High School. Our video today is on mental accounting and consumer choice, based on Richard Thaler's groundbreaking work from 1985. This presentation delves into how individuals categorize, evaluate, and track their financial activities, challenging traditional economic models of rational behavior. Our objective today is to understand the psychological factors influencing consumer financial decisions. Mental accounting refers to the cognitive processes by which individuals categorize, evaluate, and keep track of financial activities. There are three main components. First, segregation of income and expenditures. People treat money differently based on its source or intended use. For example, a bonus might be spent more freely than a regular salary. Second, budgeting and expenditure tracking. Individuals set budgets for specific categories, such as entertainment or groceries, and diligently track their expenditures within these categories. Third, evaluation of financial outcomes. Decisions are evaluated based on specific mental accounts rather than overall wealth. This means people might feel poor in one category, like savings, while having plenty in another, the vacation fund. Consider the story of Mr. and Mrs. L and Mr. and Mrs. H, who went on a fishing trip. They caught some salmon and sent it home, but the fish were lost in transit. The airline compensated them with $300. Despite the money being fungible, they categorized the $300 as a windfall gain and spent $225 on an extravagant dinner, much more than they usually would. This demonstrates how mental accounting can lead to different spending behaviors based on how money is categorized. In another story, Mr. X is up $50 in a poker game and calls a $10 bet with a queen high flush. Mr. Y, even in the same game, pulls a king high flush. Mr. Y thinks, if I had been up 50, I would call it too. This shows how poker behavior is influenced by the current position in the game, not by overall lifetime winnings or external events. The current state of mental count influences decision making. Let's examine anecdote 3. Mr. and Mrs. J saved $15,000 for a vacation. They bought a new car for $11,000, financed it at 15%, but didn't use their savings, which earns 10% interest. This illustrates a violation of fungibility due to self-control problems and fear of not repaying the vacation home account, while the car loan will be repaid on schedule. They kept their savings intact despite it being economically irrational. Mr. S admires a $125 cashmere sweater, but doesn't buy it, thinking it's too extravagant. Later, he receives it as a gift from his wife and is very, very happy. This highlights how people give gifts that recipients wouldn't buy for themselves, a common strategy in gift giving. It showcases how mental accounts for spending and gift giving are distinct and influence behavior differently. Mental accounting significantly impacts how people spend money. For example, people are more likely to spend money categorized as a windfall income more freely. Additionally, framing and context affect spending behavior, altering how consumers evaluate and react to financial transactions. This can lead to irrational financial decisions based on how funds are mentally labeled. Let's evaluate purchases through the lens of supply and demand analysis and transactional utility. Supply and demand analysis says that prices adjust to clear markets, ensuring that supply meets demand. Transaction utility. This concept explains why prices are sometimes set below market clearing levels. It refers to the perceived value or disvalue of the financial terms of a deal compared to the reference price. For instance, getting a good deal on a sale item feels more rewarding. There's also the importance of relationships. Sellers with ongoing relationships avoid setting prices too high to preserve long-term goodwill. This is common in businesses relying on repeat customers, like restaurants or concert venues. Let's look at some sporting event pricing. Ticket prices for sporting events are set differently based on their share of total revenues. League championships. For events like the World Series or Super Bowl, ticket sales are a small share of total revenue, so prices can be higher. On the other hand, there are one-time events. Events like the championship boxing match have high ticket prices because there is no significant long-run relationship to maintain. There are different ways to increase raising prices. Business uses various strategies to raise its prices. One being increased perceived reference price. Adding luxury elements can increase perceived costs, like upgrading a rundown grocery store with a fancy bar. There's also the idea of increasing the minimum purchase, requiring larger purchases or tying products to something else, like bundling Super Bowl tickets with airfare, hotel packages. There's also the idea of obscure reference price, making transaction disutility less noticeable by selling products in unusual sizes or formats, like a large container of candy at movie theaters. Now let's look at gift giving. Gift giving practices often defy standard economic theory. Standard theory suggests giving someone already consumed by the recipient. Common practice, however, involves giving someone something the recipient wouldn't buy for themselves. For instance, a group gift for a departing employee might be more expensive wine than the typical employee buys, showing thoughtfulness and appreciation. So, what are the market implications of this? Well, marketing high-end goods involves targeting the giver rather than the receiver. Advertisements might suggest specific occasions for indulgence, encouraging consumers to relax shadow prices for special occasions. For example, they might propose high-cost beer for special gatherings or luxurious products for holidays or anniversaries. In conclusion, mental accounting combines economics and psychology, suggesting that it can significantly affect consumer spending behavior. Understanding mental accounting can help predict and influence consumer choices more effectively. Thank you for watching, and I hope you gained valuable insights to the fascinating world of mental accounting and consumer choice. This is your high school researcher, and I hope you watched the video.